Hi everyone, I'm Ken from Crypto Trading KS. If you're new, a very warm welcome and welcome back CTKS family. Here you'll learn how to become fearless in financial markets. To assist you to become more of a financial and emotional blessing to yourself and those you love. Most people will look at the news to try to get an idea of where the markets are headed. Of course, it's a good idea to look at the news, but the charts will always tell you what smart money is doing, and it can often be the opposite of what the news tells you. One thing that we're noticing right now, the DXY has hit a really critical level. The 2-year and the 10-year are also very important. There is one saving grace, and that is Apple. If you're inside the service, 4 indicators were released today: Doge, Microsoft, Nvidia, and Tesla. I'm going to explain how the levels on the DXY, the US 2-year and the US 10-year, are so vitally important to understand. If the DXY takes off, it's going to be really problematic for markets. If it falters and it decays from here, it's going to be fantastic. Also, we've seen a huge amount of liquidations inside the crypto market, mainly to the long side. Pre-market, the VIX has also been jumping up. When it comes to being a professional investor and trader, caution is really important. You use caution to dollar cost average in on the best possible times. And if you're trading, then you're implementing your 3-dimensional risk management. If you like the content, please subscribe to the channel and smash that like button. All indicators that I use come from the CTKS Method service at ctksmethod.org. Let's run the numbers. When looking at the DXY, we can see it's way above its normalized positive price path. This has extra special significance when you're doing your timing. I'm just going to zoom in to that price action. When looking at recent price action, we need to gain an understanding where is structural support and structural resistance. After all, the DXY has been around since 1967, in excess of 20,700 days. Let's pop on the indicator, which applies level 1 and level 2 standard certification to reveal these structural levels. One thing that we can see, if we get above this 102.5322, there are a couple of other minor levels of structural resistance. But if we get above those, I believe the market will retrace quite substantially. Why do I think this? Because as the DXY comes up, we typically see a retracement, especially in Bitcoin. This is Bitcoin overlaid on the DXY. This white line is the S&P 500 futures. You can see this overlay. What happens when the DXY goes up? We expect the S&P 500 to come down. We need to be really careful, because if we get a huge spike up in the DXY, it could just keep going. Why is that? Because there's a positive fresh air gap up here. That's kind of nasty. We do not want to see the DXY get above 102.60. By doing the timing cheat sheet, you're gaining an insight into how financial markets actually operate. When we look at the US 2-year yield, what we see is it's just like the DXY. It's following the normalized price path, the positive one, but it's a little bit weaker than the DXY. But typically when the DXY comes up, yields come up. So are we looking at anything problematic in the US 2-year? Yes, we are. I'll zoom in. The US 2-year yield is a really important thing to track, and when we pop on the indicator, which gives us an analysis of more than 13,000 days worth of data, we can see that the US 2-year yield has been struggling with this 4.3942% mark. If it gets above here, it's got a fresh air gap above it. It looks quite similar to the DXY. It would be very different if there was a heap of structural resistance here. Unfortunately, there's a heap of structural support below the US 2-year. The US 2-year yield has been coming up for some time, and let's have a look at what's happening with the S&P 500. As the yields and the dollar increases, the S&P 500 and the stock market decreases. This has also been placing a lot of negative price momentum inside crypto. Typically, people just look at the market that they trade in, but realistically, you need to look across all markets. That's why I created the cheat sheet for you, and it's free. You can just download it at ctksmethod.org. We can see when we look at the S&P 500 and we know no stock market and no stock can resist the US market. And if the markets are coming down, Bitcoin will be coming down as well. All markets move together. That's why timing is absolutely critical. What we can see here from pretty much the end of the year, the S&P 500 and the NASDAQ and the Dow and the Russell, they've all been coming down. If we zoom out a little bit, we need to know where the S&P 500 can find structural support. After all, it's been trading since 1871, more than 55,000 days worth of data. There are two types of trend lines that you can draw. You can draw a non-statistically significant trend line, such as this. For example, 2 points, and I just draw a line. Now, what does this mean statistically? Not much, because even though it's close to recent price action, that doesn't mean anything, because all markets have a structure. Level 1 and Level 2 standard certification give you the tools to mark up that structure for yourself at any time you wish. Now let's have a deeper look into where structural support and structural resistance levels are for the S&P 500 and how are they relating to the DXY and the US 2-year yield. You'll find as you progress deeper and deeper into your understanding of financial markets, everything relies on structure. Literally, price is moving between structural levels. If it comes down, it's going to get caught by safety nets, especially if they're strong. But if it can't hold it, it's going to move to the next one. What we can see right now is the S&P 500 has a level of structural support playing in here at 46.93 and 49. But where is the structural support underneath that? We can see it's getting quite light as the DXY is getting close to taking out a structural resistance level and the US 2-year as well. The S&P 500 is getting close to losing a key structural support level. Does it mean it will lose it? Not necessarily, but you've got to be aware. Being aware of positive and negative air is really important. When we look at the US 10-year yield, which has been trading for over 40,500 days, we can notice it's maintaining its positive price path. Just like the DXY, just like the US 10-year, the US 2-year, they go together. As always, we need to understand where are the structural support levels. If I just zoom in to that recent price action and make sure that I'm overlaying total market structure, what do we see here? Are we coming up to a lot of resistance? Have we got support below? Where are the actual structural support and structural resistance levels? Well, let's pop on the indicator from the service. What we can see, there are so many structural levels of support, and it's been grinding through, just reconfirming as support. This is not what we want to see at the current time. But reality is reality. Being aware of positive and negative air is really important when we look at the US 10-year yield, which has been trading for over 40,500 days. We can notice it's maintaining its positive price path. Just like the DXY, just like the US 10-year, the US 2-year, they go together. As always, we need to understand where are the structural support levels. If I just zoom in to that recent price action and make sure that I'm overlaying total market structure, what do we see here? Are we coming up to a lot of resistance? Have we got support below? Where are the actual structural support and structural resistance levels? Well, let's pop on the indicator from the service. What we can see, there are so many structural levels of support, and it's been grinding through, just reconfirming as support. This is not what we want to see at the current time, but reality is reality. It may have appeared that Bitcoin was not doing too badly, but in truth, it's underneath its positive normalized price path. It's underperforming the market. Why is this? You already know, because the DXY, the US2, the US10. This is the power of understanding what the cheat sheet reveals to us. What we're counting on right now is the DXY. Let's turn our attention to Bitcoin. Bitcoin has so much enthusiasm because of the spot Bitcoin ETF. So many major players want approval. Bitcoin is undoubtedly doing better than the S&P 500 in terms of strength, but it's still far weaker than where it should be. Right now, we would anticipate the Bitcoin would be north of 46,000. It's 44,000. This is the direct implication of the DXY, the US2 and the US 10-year yields coming up. And of course, if they're coming up, gold and silver are getting crushed. Bitcoin is holding up well, but we can't say the same for poor old Solana, which did incredibly well. It's still up quite a lot, but the concept is it's come down quite a lot. It's now following the normalized negative price path. If Bitcoin was truly positive, all the alts would be just screaming upwards. Solana would be much more highly valued than what it is right now. You can see the direct implication of the DXY, the Forex pairs, and the yields. If the DXY and the yields weren't doing what they were doing, we would expect total crypto market cap to be over 1.8 trillion. It's currently under 1.6 trillion. These relationships really matter. And because you're doing the timing cheat sheet, you're getting that hands-on experience. That's the most valuable thing that you can ever get. The other thing to note, when the major US indices start to come down, they throw negative price momentum across all of the major indices across the globe. That also means the components of those indices are under pressure, negative price momentum. When you're doing timing, always remember you control the trade or investment, but the market controls the return. As you get better and better at timing, you'll raise your synchronization factor, but the key is you need 3 different strategies to play out simultaneously inside the market. You need a down strategy, a neutral strategy, and an up strategy. For example, if you're activating the down strategy, you might be lowering your average position size around the current price and weighting it more towards lower structural support levels. Typically, if people are inside Zone 1 and Zone 2, they want certainty as to where the market is going, never realizing the true certainty is internal, not external. This means inside Zone 3 and Zone 4, the professional zones, we have the absolute certainty what we're going to do because we've already made up our mind. For example, if the market has negative momentum, and I've been talking about the DXY and yields doing mean reversion for weeks now, this is not catching us by surprise at all. We've been expecting it. Therefore, were you lowering your average buy price, or that is position size, and were you weighting your lower Borsog levels, those buy on red, sell on green levels? Or are you fully invested at the current time with no capability to buy anything as it dips down? These are questions that you need to ask yourself. Inside Zone 1 and Zone 2, people look for external direction. Why do they do that? Because they just simply don't know how the market works. It does take time. That's why I released the cheat sheet. I want you to get really good at timing. Therefore, you can create not certainty but probability on where the market is going and certainty as to what you will do if the market goes that way. When you have certainty inside yourself, you'll know exactly how to deal with these scenarios. Gold and silver are under pressure at the current time. This is not what we want to see. But there are some saving graces, and it comes in the form of a nice juicy apple. To understand why it's important, we need to look at the structural levels on Apple. Let's have a quick look. Apple is an incredibly powerful and important company inside the market. As Apple goes, people like Warren Buffett go with it. Therefore, our single most important question, as Apple is one of the largest corporations on the planet, where is structural support and structural resistance? Let's zoom in and have a look. When we look at Apple, even though it's pre-market and Apple is trading at 181 and 26, what we need to do, pop on the indicator and see where the structural support and structural resistance levels are. You can see Apple is coming into a lot of structural support. This could literally save the market, literally. If we see a bounce and people start buying the dip on Apple, and Apple is a multi-trillion-dollar company, if that is the case, that would lower the positive momentum of the yields and the DXY, and we should see a good surge in the stock market. But the probability is not weighted in that direction at the moment. It's more probable that the DXY and the yields will continue up. That's why you must keep your eyes on them. If they start to decay down, it could be fantastic buying opportunity. And just keep your eyes on Apple as well, especially the structure. You can get a copy of the timing cheat sheet absolutely free at ctksmethod.org. And for those people inside the service, the structural levels on Doge, Microsoft, Nvidia, and Tesla were released. My goal is to get your level of knowledge up to an elite level. When people start talking about the Forex, yields, commodities, and how they impact the stock market and crypto, you're already up there. The key is for you to understand it. With this in mind, if the DXY and the US2Y and the US10Y keep on their upward paths, what do you think is going to happen to gold, silver, Bitcoin, and the stock market? Please let me know your thoughts in the comments. It's really good to do this active learning. It will help you to put the pieces of the jigsaw puzzle together. One thing that's very important to understand, if people are inside Zone 1 and Zone 2, when the markets go red, that's the exit sign that comes on and they run away. Or they get really angry. And when the markets go up, they come back into the market and they get really happy. This is not the way to live. Your happiness can't be dependent on external factors. Instead, when your happiness is determined by your certainty over your own actions, you're exhibiting positive excellence. And therefore, you will be consistently profitable over time. The key is just to get into synchronization with the market. Raise your synchronization score as much as you can. Have your 3 simultaneous strategies playing out at all times. Even inside the bull market, retracements of 40% or more, especially in crypto, are very common. Make sure that you know your structural levels and be able to apply Rule 446, the intercorrelation and interdependence between markets. In life, when we get new information and new understanding, we can change everything about ourselves for the better. If you want to run away from the markets when the markets go red, please leave a red comment in the comment section on YouTube. Just leave the word red. That means you're basically seeking an exit when the prices go down. If this is the case, the first thing to do is just to acknowledge it. Unfortunately, it takes a long time in the markets and a lot of losses under your belt to understand that the red times are the best times to be in the market. But it takes a lot of time to unwire your emotional state. So if you put something like red in the comments, that will help me to focus different content for you to help you out more. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.